We are about to start our final session, and that is about the after product market fit life. How do you stay in fit? How do you make sure that your product is still relevant to your audience through research? We're going to welcome our panelists in a second. But before that, what I would love to say, and we've said it throughout the sessions here today, if you'd like to reach out to Airtime to speak with Akos, myself, Martin, you have the calendar invite in the chat. So feel free to grab a time with Akos, and we'll be more than happy to answer any of your questions. With that being said, super excited to welcome our panelists for our last session today. Akos, I'm going to hand it over to you.
Thanks a lot. And this is the biggest panel that we have, and I'm so happy to see all of you here. It's a pleasure to talk again. And the topic that I brought to you, before we jump into that, there are the rules of the game. Very simple. I prepared a few questions. I'm gonna throw these questions at various people here in the panel. I'm gonna rotate that so it's random. And what I would urge you to do is, if one of you said something interesting, reflect on what that other person said, and let's turn this into a discussion, okay? And build on each other's argument. At the end of the panel, I'm going to squeeze in some time for questions from the audience to make sure that it's also dialogue with all the attendees, and not just we're up on the stage discussing amongst ourselves. So that's the admin part. Let's get started. The topic is beyond product market fit, better measures of success in today's environment. And I picked this topic because the way I see it, product market fit is the traditional way of measuring if a startup is successful. It is typically associated with some phenomenon like exponential growth at very low marketing cost, where a company can grow its customer base through word of mouth. But at the same time, what I also observe from my seat as an early stage founder is that the expectations of investors shifted from growth to more like capital efficiency and profitability. And I'd like to investigate with you how this shift in terms of investor mindset comes together with the traditional measurement of being a successful startup. So the first question is, how do you actually define product market fit? And I'd like to send this question to Guy, the first person.
Thank you, Akos. Well, product market fit has many definitions, but I like to look at the following. First, people are willing to pay for what you sell them, but more than that, they're actually using the product in the way that you intended to be. So it's not enough that they're willing to pay, they're actually using the product in the way that you wanted them to use the product. You can go on with that to the way they refer other users to use that product. But the main two criteria is the one that I've set, in my opinion.
Any of you guys want to add something to that?
Well, maybe to add, I think a lot of people talk about all the different definitions of product market fit. I actually think it's very simple. And that's also why I think the definitions are misleading. I think you know when there's product market fit. It's that simple. You just know, because there's going to be a massively accelerating interest, customers, and you're really, really struggling to just keep up. And that's how I look at it. You know, because the moment you ask yourself, do I really have product market fit? Is there a maybe? The maybe means there's no, there's not true product market fit. You're not there yet. So that's the way I like to look at it, you know, in the most simplistic form.
Elliot, you built a business.
Yeah, but Brian started speaking and then he was on mute, so I'll give Brian the benefit to start first, and then I'll promise I'll share my insight.
Okay.
I work with a lot of startups, and so I think one of the big challenges with product market fit is, what are the indicators that you're moving in the right direction? right? So there's these external measures, and you're right. You kind of know when things become effortless, when sales start working, when you know that your customers are satisfied. Those are really good ways of measuring and having metrics around it, And so we could say that it's the inflection point between growth and scale. But I think there's several things that we can look at that lead to that. And when you're working, especially with startups, it's good to self-assess these, because if you get them all right, then you have a much higher chance of having that sense of, just confidence that it's there. And so for me, it's, you can start in the discovery phase. Do you know that it's a real problem, that the problem's acute enough that people actually want a solution? Right. As you're building it, are you building something that you can validate that the solution actually meets people's needs? Right. And you can test this while you're still doing prototypes before you commit any code. Right. Look at the competition, really identify where the gaps are. What do you have that makes you unique? If you can't answer that question, you've got a PMF problem long before the business is released. And then, of course, once you do release it, testing with customers, really listening early and often to understand, if they are happy and what their evolving needs are. So to me, the numerical measures are lagging indicators of product market fit. And we can assess it ahead of time by looking at things like our problem space and our customers and our product, and just constantly being in touch with people so that we have a finger on the pulse of how people are responding to our concepts.
That's a great approach. So, hi everyone. And my approach to the market fit was a bit different when I started, because I took a leap of faith. I bought a business that wasn't working that great and decided to pivot it from being an operator myself to becoming a provider. So for me to decide if to go ahead and do that, I was the first client to use the system. I was there to begin with. I had the vision on what would make it better as the user, but then that was my vision. And the conflict was, will I be able to sell it to my competitors or my friends in the business to see how it goes? And then I've never considered the freemium models or any other. For me, it was, I have to sell it at a price, and customer had to pay from day one, because we started 7.5 years ago and we bootstrapping it all the way up until now. I've been selling since day one, and I had pre-sales ready telling me commitments, signed application forms, we'll start paying the second you launch this thing. And then it was a complete, let's say, leap of faith and going ahead all in to go ahead and do that. So I was never the traditional type of entrepreneur to do the research and raise money beforehand and then experiment after that with other people's money. It was a little bit of my money, everything I had to begin with, and then just full running into it. So I think my approach from the audience here will be a bit different, because I literally went through all the different hurdles to check the market fit and see how will I get to the additional market besides the people I knew, because as much as I think I'm well connected, the world is much bigger than that. And so I think the approach of checking if people will pay for it, that was the main part. Can I sell it? Will someone sign before I even launch? With just not even an MVP to start with, screenshots of what I'm planning to do. And I can do that because you've seen me do it before. So for us, it was that type of the investigation beforehand. And I had about 2 weeks to make a decision of a go, no go, because it was opportunity to buy something really cheap just to make it happen. So imagine, it's not like months and months of thinking about it and making the decision. It was literally 14 days end to end, make the decision, put the capital, and start running with it as is. So.
Amazing story. Teddy, you have a unique perspective from Heartfelt and APX, right? There's a large portfolio that you're overseeing, and also very active investors. How do you see this question?
Yeah, I would say it's a combination of the prior two comments. So for us, it's all about testing that minimum viable hypothesis. So when we invest, it's literally a team, pretty bad pitch deck often, and hopefully a pretty good idea. And it's really about validating that problem solution fit. First the problem, then the potential solution, and the fit over time. I think I don't really like the word product market fit because it just means way too many different things. I think it is customer love essentially, and that growing over time, and often in a market where the dynamics are fitting that problem solution being out there and people using it more and more. I'm more of a fan of thinking about trying to identify these early signals, and it's going to be different, I think, for each type of business. Whether it is, like Riyad said, customers signing up for it in advance and saying, I want to pay for it, even though all it is pretty much a drawing in Figma at the moment, that could be a signal. You know, the signal could be like what people said, oh, referral rates are going through the roof. I don't have to spend anything to acquire customers. It could also be early signals of post solution fit that we see are purposefully founders being very, very targeted to, say, a small group of beta test users, but that love and engagement is increasing week over week, day over day. And that is usually a pretty good sign that there is some problem solution fit for that initial customer segment. I think the key is then figuring out, okay, how do I go from dominating this customer segment and expanding it to others, and also extending the value that our product is creating for existing segments over time. But I think that, like, I really like what Brian said. I used to say when I was living in London that revenue, and this was again 10 years ago, so I think it was different times in the market, but revenue is often a lagging indicator of success. And we have to really try to figure out these early kind of momentum signals showing that customers are really loving the product and want to do more with it.
Cool. Thanks a lot, guys. Let's look at the what I'm also interested about is the investors thinking. This is something I'm also trying to do, is trying to get my head around of how did expectations shift from in the last year. And there are a number of seed stage or Series A stage founders in the audience. And I think it would be extremely insightful to hear your thoughts. In what way are you thinking differently about these rounds, and what sort of indicators are you looking for that are different than a year ago or pre-Ukraine war? And I'm looking at the three active investors here. So one of you want to grab the mic?
Yeah, sure. I can go. I mean, look, I think the obvious start is the markets are just way tougher, right? So I think it was Y Combinator that coined the statement: "You gain market share simply by surviving." Right? That was I think they coined it last year, summer spring, and I think kind of that sets the stage, you know, in terms of how investors, at least how we also look at the rounds. Runways are way more important. So runways used to be way shorter. Now we really like to have 18 to 24 months actually of runway. That's what we're looking at. It's way more important that kind of optimize for, like, to be in a sustainable spot to minimize burn, right? So it's just where previous companies we looked at, there was this insane push for growth, sometimes at very unsustainable ways. Now sustainability is a big part of how we look at it. You know, can a company survive if it really gets to it? Can they break even? You know, is there a backup scenario? So these are all options that we're looking for. Just follow-on funding, you know, the rate is way slower. We have way more time to talk to companies, which is great. I mean, let's be honest, 21 was utterly unsustainable, you know, on all fronts, I think. So we're now in a way, I think, at a great time where you know, yes, it's tougher, but I think the startups being built now, it's a massive opportunity, you know. And as an investor, we just want to make sure they can survive. You know, we can't support them all the way, and that they don't die. I mean, that's a huge element now.
I will add to that point. I think what happened to the market because of this uncertainty and difficult times, in many cases, indications we expected, let's say in round A, we will look for them already in earlier stage, in seed. We would look to have more traction, more product market fit. We would expect the founders to already gain some knowledge about the product they're working on. So round A turn to seed, round B turn to A. We look for more concrete indications, more than before.
The one thing I would add here is definitely during the first 6 months since the market started turning a year and a half ago, it was incredibly important, and we still say this to our founders because we're first check investors, often investing before angels. So our pace, our risk appetite hasn't really changed because we can't really go earlier than zero in terms of a company, in terms of what we're looking for. There's no real data. But in terms of helping our companies when they're preparing for their seed, Series A rounds in the past year and a half, it's really about maintaining that dialogue with those later stage investors, later stage to us, still early stage. Because I would say a lot of these funds also did not know what they're looking for. And their LPs who said, hey, maybe we should slow down a little bit, also did not know when to slow down, to when to pick up. Should we shorten our investment cycles for our funds or speed them up? Who knows? That's why that constant dialogue was so important. I think it's still important. I think ultimately, probably we'll look back at this decade of our fund vintages and say, actually, this was for the good. And I hope other investors would agree. It sucks for those founders who are stuck. They're in that time of flux. But ultimately, I think those founders who survive will be the ones who actually build these lasting businesses. And that's kind of how, unfortunately, we have to do more with less money during this time.
So I'm gonna, oh, Brian, please, yes.
I just wanted to add to it from a different perspective, right? So my agency, we do the research, right? And we do the testing of products. And so I work for founders who are seeking investing. And what I've noticed in the last really year has been a shift to saying, hey, prove it, right? Like instead of we're just going to throw money at an idea off of a Figma slide or a PowerPoint, it's like we actually want to see real indicators that you have traction, right? That these small things you're thinking about, actually can lead to bigger things through time. So there's been a much bigger pressure on, in my opinion, doing things the right way, right? Which is, evaluating some of the factors I talked about, as well as things like business models and marketing strategies, and creating, in a sense, like a scorecard, right? And one of my colleagues did exactly this here in San Diego, where he built, and we've been using a scorecard that essentially it's a set of metrics you can create. And a lot of them are kind of self-perceived metrics, but you can back it up with good studies that say, here's where we are as a company. And I've been asked multiple times to like write a statement that says, hey, show that we actually validated the problem. What did you do as a research team? How many people did you talk to? How much of the, and I find that very encouraging, because that means that the companies that are doing this are doing their due diligence. Right. So that as an investor, when you read a document like that, you're like, okay, this company's for real. Right. And they're actually testing things rather than blowing smoke at my ass. Pardon my language.
Maybe to add on what Ryan was saying, is a lot of founders I talk to, the early stage, I also straight up, well, what kind of questions do you ask your customers? Or just to get a sense how they phrase it. And because so many times, they're just looking and hearing the questions and thinking, okay, that's not real validation. And that's really important. I mean, there's all kinds of books written about it, so we'll go into it, but just asking the right questions to your potential customers early on is absolutely crucial, not to waste time and delude yourself that you're building something that nobody needs.
Yeah. I always tell people, never ask if you like the idea. Because everybody likes the idea of something that has no indicator if they're actually going to use it or buy it, right? So it's like a wasted question. There's much better questions we can be asking.
I think it was a book called The Mom Test, written by Rob Fitzpatrick. That also, very similar lines, Brian. So,
yeah.
I wanted to pass the ball to Iliad, and I'm curious. Iliad and we had a number of discussions in the past, and in one of the discussions, you mentioned that you got frequently approached by investors in the past to like invest in your company and then grow faster. And I was just wondering, do you see any change since you have a profitable company? Do you see like a change in like investor behavior or interest in the company that you're building?
Actually, I'll take that and connect it to the previous question as well, because I saw the change in paradigm when I was talking to investors, let's say 6 years ago and 5 years ago, because I wasn't looking when I started the company. They were always looking at the Excel, show me like quick projections, show me how the more money we throw at it, the 10x growth that's going to come in. And I'm a bit of a pessimist. I build businesses. I've never looked at the business of building it as a startup to start raising funds for it in order to fuel it more. I build it sustainably. So in case I never get funded, which is the use case, never pursued it, then we'll manage to sustain the business. And that way they said, listen, this can't grow without big money. And I said, okay, I'll prove you wrong. Thank you for the time. I asked some questions in terms of feedback, how they saw some other parts of the industry that I was coming from the industry I was serving to begin with. But when we started, we were doing only card processing and alternative payment methods. And we scaled to banking and card issuing and really serving the full financial ecosystem on that part. That grew from, let's say, serving customers coming with a demand and building the first product with an actually paying customer, even for the development process. So for me, the growth was always coming from a paying customer, brainstorming together. I was giving away my consulting hours for free, but he was paying for the actual work being done. And I kept selling it to more clients, and everybody was benefiting from it. So when I spoke to investors at the beginning, they only want to see, okay, I don't see that as a 10x company. But then if you start comparing it to the likes of, let's say, us to ACI and Solaris Banks and other, you did see public companies, huge companies doing the same. But let's say my timing was a bit too early. Now, come 7 years later, spoke to some investors lately because we had some moves to consider, but it was more brainstorming with the investors on how they see the market now for having a sustainable company, 7.5 years in, bootstrapping all the way, literally what they're now looking for after, let's say, spending money in companies that have burned the money through and reached that, let's say, tough times that they needed to survive on that amount of money. And now suddenly the interest comes, okay, you proved yourself for 7 years, let's see what we can do together. But maybe the timing isn't right for me right now to use that capital in that way. And we're pursuing a more, let's say, creative points of financing specific products in rev share agreements and stuff like that from our clients, etc. So if I'm looking at how the investors, what I was pitching 6 or 5 years ago, and how I think the investor should look at things, a little bit more stable growth, not the 10x, but maybe 6 and 7 that we showed in our graphs. And I was more showing, let's say, steady growth through that process. Now they're coming into it, and that became the approach. Show me that you can become profitable. When will you start being profitable in the expenses? Which we were we were showing those results to begin with because I didn't have any other choice. I had to be profitable really early on. Otherwise, I'll have to put more money from, let's say, from my own pocket. And it wasn't interesting. I knew I can grow the company even if it's a bit slower, but it's going to be steady. And we grew the team, and we grew more developers and more support, and now sales and everything else through the mix.
Thanks a lot. Awesome. Do you guys want to like anything to that, or shall we move to the next topic? We move to the next topic. Good. All right. What I'm interested in is that, like, you were also talking about revenue, guys, you too, and it's more important for investors already in the early stages. And I was wondering, what's your take on, in typical SaaS businesses, in the freemium model, it has the free package. And I think the famous example is Dropbox, where like 90% of its users are actually in the free package and only a small fraction of them generating revenue, like larger enterprise clients. How do you see this shift towards more revenue at earlier stages impacting the way early stage startups monetize and price in the SaaS vertical? And Teddy, I'm gonna throw the question to you first.
Yeah, it's actually really relevant because I was talking to one of your fellow founders earlier today about this same topic, because I think there was this fear that if they started to charge and not knowing what to charge, because pricing models will take time to develop, right? As a customer, they're around seed stage, this founder. I think there's this element of like, oh, if I charge, I don't know what to charge, first of all. Second of all, I might lose some customers that right now are really, really great in terms of co-developing these first versions of the product in a pilot phase. I think even before the market turned, and even now, I think it's important to test willingness to pay. And I think it depends on the type of customer, like how long the sales cycles are, who's the user / purchaser at these different customers, and the base overall the value prop. But if there is a way to test it, we always recommend our founders to try it out. And it's okay if it doesn't work out. Like, it's not going to ruin the first pilot customer. There'll be more chances to bring it around, and also be a great learning for the founders to do that. I think, yes, there is a shift. We see it with our follow-on investors that we co-invest with at seed and later on, that there seems to be a bit more of an emphasis on proving this willingness to pay and figuring out potentially what the revenue model could be. But I think we all have to admit that these things will change as the product continues to iterate and as you try to find PMF. And one of the companies I was an investor in way back when we were doing angel investments, they didn't really figure out their pricing until they got to Series B, and this was before the hype. And it was completely fine. Like they got it wrong a few times, but they still had happy customers. Some of them still sticking around till today. So yeah, I would say that's my thought on that one.
If I can chip in, so luckily enough, I'm a mentor for Guy in Techstars. That's how I met you guys, and I love the Mentor Madness sessions. For me, it's like a day off. I can brainstorm with a bunch of, let's say, really creative entrepreneurs, and now the pricing always comes in. If I look from the last 2 rounds that we did, I think with the majority of them, we were brainstorming problems. That's what I like to do in those 15 minutes. And the majority of them was looking at pricing. And some of the groups were focused on a product that was more enterprise level. They were looking at long sales cycles, and now it becomes a lot more problematic at sorts. And we managed to brainstorm a lighter product, which will be for the smaller SMBs, and that part, which the sales cycle is pretty much self-service for services that they will never consume or gut, because the companies are focusing on large enterprises, huge tickets for every sale, and that part, which will become problematic. So suddenly you see from a huge ticket sale to something on self-service with a lighter version of it that they were never thought of doing. And we'll see that in the market. A lot of the big companies are actually starting to introduce those lighter models, not going all the way extreme to the freemiums, but rather giving something that the smaller company will start consuming, something that they've never thought of charging, when for them the investment in terms of shifting the product isn't that large, because it's a lighter version of what they built. It's kind of a MVP that they can show even the enterprise client. Look, I have a lot of small clients that using the light. You can use the more advanced software. It's no installation and so on to start running with it. Some actually from the companies that I've, let's say, worked with over the years, shifted of not even doing enterprise and just focus on that lighter, because then the multipliers of the amount of, let's say, growth they got for these kind of services actually picked up really nicely and decided to focus just on that. And maybe once a year they do an enterprise sale rather than focus on that. And I think that's where we're going to see people, as Jack Dorsey said, keep the number of features to, let's say, to perfect, and every feature perfect on that part. Even though I'm more of the LinkedIn founder approach of that, if you launch something that you're proud of, you launch too late. So, but it's a matter of, it's pretty much right now, let's take part of what Jack says, and let's say shifts, let's say deliver something which is smaller in terms of your vision of where you want it to go, see that the people are willing to pay even a smaller amount of it, and slowly start adding the add-ons and increasing the price based on it. But don't keep it complex. Don't start charging per feature, because you'll never be able to sustain that account, let's say the accounts part of it. You'll never be able to charge properly. You have to invest a lot of money in calculating how much money you need to charge the client. So listen, I'm expanding the product. This feature will cost a bit extra. The new price for the service is $5 extra, $20 extra, and so on, until you get to the package you feel complete with. When I launched, I had a pricing that I had set in mind that I wasn't overly expensive as to my competitors. I had a lot more functionality to start with, because, as I said, I bought at base of a company and shifted what the company was doing to something else. But let's say I was pretty set on what I was delivering. I knew I was launching, let's say, a very sustainable working, I'll call it beta because I pivoted the offering, but I've never negotiated the price. My pricing is on the website till today. And then whenever I did a redesign or something new, we broke things apart, and there's another plan. The old clients kept their own pricing. If they want to use those things, we shift to a new pricing model, but then later shift all of them and close the old program. And people focus on, let's try to get growth at any cost. And then worst case, we'll think about something later. And now if you start thinking about it as a business rather than just as a startup, that changes it. And the discussions with the startup, Nikos can testify to that. We talked about it a lot even after the program. It's something different, because everybody was talking about only the pitches, reaching investors, etc. And suddenly you think about, let's start getting paying customers and see how they go, rather than just building the pitch deck throughout the process.
Brian, yes, I wanted to ask you, and I'd like you reflect on what Iliad said, but please also include. You must have had some engagements with your clients around researching pricing and how to price, and I'd be super interested in what you found for earlier stage companies when they introduce their first prices, or as they refine their initial pricing.
Yeah, I think, I can speak really about the last 3 or 4 clients that I've had, and I've seen a shift, right, and different approaches. I'll say from an end user perspective, first of all, I'm a huge fan of freemiums because I love trying out new software, and that gives me an opportunity to see if I like something, but I have an expectation that I'm going to be paying for it if I like it. So just from a user perspective, I think it really helps with the go-to-market strategy if you can offer a freemium model to people. However, at the same time, just to have a freemium and say, justify to your investors that, oh, well, we're just doing this to get a number of people with traction, right? I feel that that's a bit of a cop-out, or it might be used as an excuse when you don't actually have any indicators of product market fit. So if you're going to use the freemium model, there also needs to be a premium model. And what I see is there's more of an emphasis on demonstrating a conversion rate up. So it's like, okay, you can have a freemium model, and that's a great model for attracting new people, depending on the type of product that you have, of course. But it can't just be that. It can't be like, oh, well, we're going to do this, and then later we're going to add the premium model. There needs to be some metric that shows that you are getting a shift in adoption. And that's one approach I've seen. Is the other one, though, is, really what you were talking about, Iliad, which is the sense of don't start at all with the freemium. Start with very small ways of making money on things that deliver value to people, and create a pricing package around those. It's just enough to get the business going, like just enough to take your part-time workers and make a couple full-times, or hire that next person that you need, right, to help the company grow. And have the capacity then to add on more features that add more value. And then as you add each unit, it's kind of like Legos, right? As you add each unit, you create either new pricing models, or I really liked what you said with variant pricing models, in the sense that, hey, if you want to stick with what you've been doing and this is your feature set, by all means, stick with that, right? But if you want to take advantage of these new things that we've been building, then it's a different price package. That to me feels very transparent, between the company and the customers. And a lot of customers are pretty savvy these days, right? So they will be looking at how you speak to them, and they are very aware of tricks. And so if you're just very transparent, then I think that works with early stage companies. And so again, I'm a big fan of what we call value co-creation, which is where the company is in regular communication with the customers, not only to determine, things like product market fit and what should we build next, but just to establish a relationship with them. And if I'll tell a story here to end up, Nike did this a long time ago. And, they opened up and said, hey, we're going to have a portal where customers can start designing their own shoes. Now, I think we all know how massively successful that was, right? So I look at that, and to me, that's a golden standard that I really advocate with my clients.
I think Lego has that, by the way, as well. That people can design Legos and send in the plans for that, and if they're good enough, it's picked up by Lego itself. So they let their own customers co-create a product for them. Cool, Guy, Mike, do you guys have anything to add to this topic?
Much has been said about the freemium model. In general sense, if you go freemium, you need to have a clear understanding that you will find a way how to monetize it. Freemium model in our current, I assume, climate is not sustainable for the long run. And you need to find ways to monetize. That's my 1 cent to add, which was said already by several people here.
Yeah, I'm also not going to repeat. I think it's been said. I think in open source we face a similar problem, and I just love founders who deeply think about this. So it's great. I mean, similar to what Brian said, I love freemium. But I just want to invest in founders who really deeply think about this and know what they want to monetize. And that can change, right? I mean, all this stuff changes all the time. But that's important to me. So like not to look at founders who just, let's start free and we'll see where it goes.
I'll add something because Brian brought up something that's really important. It's difficult for a founder that starts as a bootstrap company to to think about what to focus on next in terms of development, and not just to launch, but rather what will be the next feature I'll put my, let's say, emphasis on, and what I'll develop next. And I think the trial, there's always the conflict of, let's say, talking to a new potential client. He says, you don't have this feature. If you build it, I'll come in and I'll sign up. And then what happens? Young founders run, develop that thing, nobody uses it, and that client disappear, never respond on that part. And for us, we always, even the beginning, but we keep sticking to it now, we love those kind of discussion, because what we did, we built up the hype for the customer, thinking that, of course, we're going to run and do it. And then we brainstorm and get more features and more ideas on it. And he got excited. And then I pushed the brakes and said, fantastic, but we only develop new features for paying customers, and then we can participate with you in the development. And then you see if he's actually serious, and then moving on to become a customer, if it makes sense to even develop it, because he's putting money out of pocket to actually pay and, let's say, contribute to the cost of developing that feature with you together. Because he understands that the value will come in, you take him seriously, but only if you do it for paying customers. Meaning you as a company will always stay focused on delivering products that your clients will actually use, and not running around with prioritizing something else just to get the next client. You're showing him that you're only investing in paying customers rather than chasing the next one. And once he signed the contract, paid you the setup, he's no longer relevant. He's just another client in the mix rather than being the most important one. I'm not chasing leads and getting them excited. I'm making my clients happy, and by that getting them to refer me to their clients and testify that they're happy, and so on and so forth.
Thanks, guys. Awesome thoughts and stories shared here. There's an anecdote I wanted to tell you. A friend of mine with his wife came over to our place a couple of weeks ago, and he's a founder. He had a couple of convertible rounds, raised about 400K, and recently, what he decided to do is to turn his business on profitable path. And now his company is profitable. And now he's actually thinking of how to get rid of it's a nasty word, but like how to negotiate with convertible loan holders to change the game. Because when they invested, they were investing in a 10x story. But then he's saying, I have a good business here. I make enough money. I have 10 employees, it works fine. And I was just wondering, is this in a single anecdote, or do you see any trend among founders that because of increased expectations, if they have the possibility to turn profitable, they may take another course, which is not the classic VC high growth?
I actually, maybe to comment, I think founders in general maybe think way too quickly about a venture where it shouldn't be a venture case at all. And in fact, I think you can earn so much money building a great lifestyle business, and I think that's often overlooked. So first of all, oftentimes the market is simply not there. It's not a venture case, so we shouldn't invest. But even if it is, the question is, do you really want it? And that's a big question, because I mean, with investments, there comes expectations, and that's not for everyone. So I think that's an important question to ask yourself. I mean, first of all, is it a venture case? Is the market big enough? And the second, do you want it? And again, you can build an amazing lifestyle business. If you make a couple of million, and you pay yourself out every year, and you grow sustainably, great. With a small team. I mean, do you really need to build $1 billion company? So I think that question should be asked more often, and also whether it should be a venture case at all.
That's a very good point. Teddy, do you see, like, again, going back to the large portfolio of APX and the Heartfelt, you must have seen a number of trajectories that your startup companies went. What's your take on this?
Yeah, we had actually 2 companies in the APX portfolio this year where the founders decide to leave the venture path. I think when there's alignment, it's awesome. When the founder's like, look, we are breaking even or soon to break even, and we don't want to be on the venture path anymore, and they communicate that well to their existing investors, I think that's completely fine. We'll figure out a way if we can to make money. If not, then the founders are on their way to create a lifestyle business. I guess the other situation, the other company was a bit different, because it would take more time, more capital to become profitable, more runway. and the founders didn't want to go on the venture path, but they're still promise. And they were actually getting inbound from investors, even in this climate, saying, why are you not going out? Because the growth was good, engagement was good, and there was a chance to get to the next stage, to Series A. But the founders were done with it. And they communicate that too in a nice way. And in that way, actually worked with the investors to engineer an exit for them. They said, I don't want to be on my own venture path. I want to work within a larger company. So let's figure out a way to make this happen. And I think both are fine. And I think that's also part of an investor's job, is to figure out, hopefully before the investment is made, whether this will continue on the venture path. But if it, for whatever reason, doesn't continue, and for us, especially the early stages, it's more driven by the founders, unless the business is not proceeding in that direction, then I think it's fine to have that conversation with the investors and figure it out. Because it's the founders' business. The investors are just there to be cheerleaders and open a few doors and maybe share some stories amongst themselves in the portfolio, but really comes down to where the founders want to go.
Cool. The rest of you guys, Guy, do you have maybe a perspective of that? You've been a founder, you created a number and built a number of startups. You've been an investor in multiple, so you've been in both seats. How do you see this?
I think that the sentence, you don't need to build a billion-dollar company to be successful or happy or satisfied with your creation, is the best conclusion. I agree with that. I support that. Yeah.
Okay, cool. Guys, last question. And I know in life there are two things for certain. I know that's what they say, taxes and death. But I still like your like sentiment and thoughts of how long do you think this current market will last in terms of investor startup dynamics? Because from my perspective, it seems like we're on a sinus curve, which used to be on a very high wave for founders, and now it's plunging very deep. And I'm curious how you see this curve developing moving on. And yes,
No one takes it all.
it's the hot potato.
I can take it.
But I'm still curious.
Look, I think the problems are fundamental. You know, like for 10 years, you know, interest rates have been close to zero. You know, there's been a party like there's no tomorrow, and on top of it, went through Corona, and that really impacted global supply chain. And now we have a war situation in Ukraine. I mean, there's a lot of things happening, right? I think when we start looking at macro, I've heard, at least it was a bit early in the year, a lot of sentiment of, you know, soft landing and things are going to be way better Q4 and next year. And honestly, I'd buy it. So my personal opinion is that we're in it for a bit, you know. Again, that's just my opinion. I think next year is still going to be tough. I think there's a chance that also when you look at public markets, that things may go south again. You know, I don't know, but that's definitely an option. So, like, I would just prepare for sustainability. You know, just accept what it is right now, hope for the best, and prepare for the worst, and be prepared to sit it out. You know, however long it lasts. But I do think it's gonna last for a bit. That's my opinion.
Brian, how do you see it from with the founders and startups that you're working with? What is their expectation or thoughts on this?
I can't speak for all founders, but I know that with the people that I work with, they're not concerned. There's this idea that the problems that we're solving aren't going anywhere. The opportunities that exist aren't really being seized by companies. So with the people I'm working with, I really feel that there's a niche, right? One of them is more so than the other, but social conditions around some of these are not changing anytime soon. And in fact, they're getting worse. And so we don't need to wait, for the investment market to change. I think that we'll either figure it out bootstrapping it, or we'll get some people that believe in it and give us just enough to get the MVP off the ground. And I'm pretty confident that once it's in people's hands, in both cases, that we're going to start to see customer love and we're going to start to see adoption. And so to me, I think the big thing is making sure that the founder isn't putting himself upside down in terms of money. Like, let's say that this takes us 2 years to get it off the ground instead of 6 months. Can you still pay your bills? Right. So some of the founders I work with, they have another company, right? And that pays their bills while they build the new one. And so they have to just maintain that balance. But I don't see any of them being like, oh, I'm going all in on this, and I'm going to go get venture capital and we're going to be successful. They're not taking it that way. And, and I think that's a smart strategy. And I think that I live in San Diego, and I think that attitude and that climate is prevalent here. People are being much more diligent, much more cautious, much more methodical. And it was really different a couple of years ago.
And maybe just one thing to add to what Brian said, I think the opportunities for automation, hence efficiency, and hence like being more cost efficient for companies are incredible right now, given where technology is and how fast it's growing, right? So there's an immense amount of opportunities for startups.
I think in a word, at least from what we see from our end, the same as Brian sees that with his customers, people are more inclined to rent it rather than to build it. As to before they raised the funds, they were building it and say, why would I rent from someone, let's say, as a platform, and now they have the opportunity, says, listen, I need to be more cash efficient, so let's rent out, see if it works, and then if we manage to raise the funds and we see the clients, then maybe we'll build it afterwards, and then kind of grow out of it at that stage. At the end, nobody grows out of it, and they're enjoying it and investing it in other places. But I do see a lot of more people discuss with me like 2 years ago and saying, listen, I prefer to buy, let's say, to build it myself rather than to be owned by someone like myself as a platform, and everything is built on top of the platform, which will be difficult to migrate. Suddenly there's much more, let's say, willingness to go into that adventure that way, because it costs them significantly less money to start. And then they say, let's experiment. If it works, fantastic. If it doesn't work, I didn't invest that much money. I didn't burn all my savings in order to do that. So they launch much faster on that, which for me, it's great. More customers for us coming in. But we do see a better willingness to do that.
I would add to it, I wouldn't wait to see when the wave is changing. I say don't be dependent on the wave. Build your startup, build your venture in a way that you can do it without the VC. You will find a way to do it. If you do well, the VC will come after you regardless, whether it's a wave or not wave.
Awesome. Teddy, you get the final word.
The final word, I don't speak words of wisdom. I have a personal view. I think when the market will turn, but let's see. Who knows? If I knew, then I wouldn't be sitting here. Probably I was sitting on a beach. Yeah, I think for me, the founders should always be resilient. We always talk about resilience, right, as founders, and being resilient is being mindful of the times we're in and what solution you're really truly building in terms of the problem you're solving. And the problem the solution fit will adapt to the market environment. And if you're truly a founder who's targeting, hey, I want to make my customers really happy, and I want to build a enduring and category defining business, then they're going to be resilient and adapt to the conditions to do that. Whether it means shifting in terms of how I do get my customers, shifting the business model itself, pivoting quickly. These are all things that I think excellent founders will do. And the founders who were successful during the hype, it's a different type of founder probably that's going to find success in this time too. But they'll still demonstrate those core qualities that at least we look for as investors. I would say most investors would look for regardless. And I think it's actually the best time to be building right now. It's actually more reflective of reality. So for me, it's great. The past few years are crazy. And there's still plenty of dry powder out there in Europe. And yes, it's a bit slow now, but it's going to turn because the money's out there.